Whether you're new to investing or even a pro, we have for you 5 essential investment tips that will help you to get better returns. I personally made some of these mistakes myself and we share them with you now so you don't repeat them. An idiot will never learn from his mistakes. A smart person will learn from his mistakes, but a genius will learn from other people's mistakes.
Once you know the basics, investing is extremely easy, but many investors underperform the market and many beginners lose money. Why is this? Check out our 5 investing tips.
Welcome to Unshackled.com, the investment channel that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button, click subscribe, and check out some of the cashback offers in the description below. Let's get into it.
Tip number 1, diversification. We hear this so many times, but it begins to get boring. But time and time again, new investors fail to diversify. Diversification protects you as an investor from risks specific to a company, a sector, a country, an asset class, and so on.
No matter how good of a stock picker you are, a negative event could destroy your investment and cause the share price to go into free fall. I remember this happening to Ladbrokes a few years ago. I had just bought the stock, and then the government announced that they were going to review the maximum stake that could be bet on a fixed odds betting terminal. Just the announcement of a review caused the share price of gambling companies to plummet. Luckily, I was well diversified, so not the end of the world.
Diversification also means over different geographies. Whilst the UK has been suffering with Brexit uncertainty, the US stock market has powered ahead. But are yesterday's losers tomorrow's winners?
Tip number 2, sell losers, hold winners. Very often a beginner will sell winners early to realise a profit, but they will hold on to a loser until it recovers, which sometimes it never does. This is a classic noob error. The winner often, but not always, goes on to have continued success, whereas the loser often continues to struggle for years.
Not only have you failed to capitalise on the winner's continued success, but you are also suffering by holding on to the loser from opportunity cost. You could have accepted your losses early and then reinvested in better stocks, which may have since skyrocketed.
Tip number 3, don't underestimate fees. One of the main reasons experts recommend that you don't overtrade is due to fees. Every time you invest, you incur trading fees, bid offer spreads, stamp duty, etc. This eats into your profits, or worse, amplifies losses.
Also, fund management fees or seemingly small platform charges add up and decimate overall returns over the long term.
If you combine this with expensive financial advice charges, then you may lose all of your returns to those nasty fees.
Tip number 4, plan for taxes. Planning for future taxes is essential if you intend to make some serious wealth from your investments. Early on, most investors needn't worry about taxes because you get a very generous capital gains allowance and a small dividends allowance.
However, the best thing that you can do is to invest through an ISA from the very beginning to protect your money from the greedy taxman should your wealth grow. Who knows what tax changes a financially incompetent socialist government could introduce?
You should use an ISA from day one because annual ISA contribution limits may prevent you from quickly moving your investments to an ISA, and in any case, you would incur trading fees if you were to transfer your pot to an ISA at a later date. Surely it's better to plan ahead.
Outside of an ISA, you have a dividend allowance of £2,000 before you pay tax. This was recently cut from £5,000, and we wouldn't be surprised if a future government was to cut this further.
Tip number 5, don't be a sheep. All too frequently, investments enter bubble territory. Don't be the loser who piles in at the top to only see the bubble burst. If an investment starts to hold a silly valuation, then there is too little upside relative to the potential downside that you are now exposed to.
You want an investment with lots of potential but little downside. This could be considered to be your margin of safety. During the dot-com boom, tech companies were getting silly valuations, and we all know how that played out. Never be worried about missing the bus, another one will be along shortly.
This tip can be extended to tipsters. Never follow blindly the advice of so-called experts. What credentials does the tipster even have? Most likely they are trying to increase positivity around a stock to artificially inflate the price of the stock so that they can bail out earlier having made a quick profit.
This is not to say that stock tips are never useful. They can be great for generating ideas, but always do your own research.
In fact, when every person and their dog are giving stock tips, then it's probably time to get out of the market. This is a sign that the overall markets are overvalued.
Question of the day. What other investment tips do beginners need to know? Let us know in the comment section. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.